Right now, while you are watching this, while the screens are still updating, while the numbers are still flickering as if everything is normal, something irreversible is happening behind the scenes. This is not a theory. This is not a projection. This is not a scenario. This is confirmation. The silver market has crossed the line from stress into failure. What we are witnessing is no longer a squeeze. It is no longer manipulation. It is no longer suppression. It is a bank run. And once a bank run begins, it does not stop because of reassurance. It does not stop because of official statements. It does not stop because someone tells you the system is sound. It only stops when there is nothing left to withdraw. The reason you need to understand this immediately is because silver is not a stock. It is not a bond. It is not a speculative instrument. It is a physical asset with a finite quantity, and that quantity is now being pulled out of the system at an accelerating rate. Vault withdrawals are no longer steady, they are no longer linear, they are spiking. And when withdrawals spike in a fractional system, collapse becomes a matter of timing, not probability. For decades, the silver market functioned on a single assumption that everyone quietly agreed not to challenge. That assumption was simple. Not everyone will ask for delivery at the same time. That assumption is now dead. The moment confidence breaks, the moment participants realize that silver on a screen is not the same as silver in hand, behavior changes instantly. People stop trading price. They start trading availability. This is the psychological switch that destroys systems. You can see it in the data if you know where to look. Withdrawals are accelerating not because price is rising, but because trust is falling. This is the most dangerous phase. When price rises, people hesitate. When trust collapses, they rush. And rushing is exactly what is happening now. What makes this moment different from every silver scare before it is that the demand is no longer coming from speculative money. It is coming from entities that actually need the metal. Industrial buyers do not care about charts. They do not care about technical indicators. They care about one thing: can they secure supply? When those buyers begin to compete with investors for the same physical inventory, the market stops functioning as a market and starts functioning as a rationing system. And that is exactly where we are heading. Every withdrawal you are seeing is not just metal leaving a vault. It is a signal. It is a vote of no confidence in the paper system. It is someone choosing certainty over liquidity. It is someone deciding that the risk of holding claims now outweighs the inconvenience of holding metal. This is not happening in isolation. It is happening against a backdrop of global stress that is quietly tightening from every direction at once. Supply chains are no longer global, they are regional. Export controls are no longer theoretical, they are operational. Strategic materials are no longer treated as commodities, they are treated as security assets. Silver sits at the intersection of all of this. It is essential to electronics, essential to energy, essential to military systems, essential to monetary trust. There is no substitute at scale. There is no reserve capacity waiting to come online. There is no warehouse full of surplus metal that can suddenly flood the market. What exists is what exists, and what exists is being removed. This is why $100 is not a target anymore. It is a consequence. The mistake most people make is thinking that price causes behavior. In reality, behavior causes price. When withdrawals accelerate, price has no choice but to follow, not because of speculation, but because of competition. When multiple parties need the same finite resource, price becomes whatever is required to clear the market. And when the market cannot clear, price gaps. This is why silver does not move like equities in crises. It does not grind, it jumps, it reprices, it skips levels entirely. The system tries to hide this for as long as possible. It uses paper volume to create the illusion of liquidity. It uses derivatives to absorb pressure. It uses futures to delay delivery. It uses settlement mechanisms to avoid physical strain. But every one of those tools depends on confidence, and confidence is evaporating. Once withdrawals spike, the system enters a feedback loop. Rising withdrawals create tighter supply. Tighter supply creates higher premiums. Higher premiums expose the disconnect between paper price and physical price. That exposure destroys confidence further, which accelerates withdrawals again. This loop does not stabilize, it accelerates until it breaks. We are now inside that loop. This is why the focus must shift away from daily price movements and toward inventory behavior. Inventory does not lie. Inventory does not speculate. Inventory only moves when someone takes possession, and the pace of possession is increasing. What you are seeing now is the quiet phase. This is when informed participants act before headlines catch up. This is when metal disappears without noise. This is when vaults drain without panic. This is the most important phase because once panic becomes visible, access is already gone. By the time the public notices, the decision will no longer be whether to buy silver. It will be whether silver is available at any price. The $100 level matters psychologically, not structurally. It represents the point at which denial collapses. It represents the moment when people who dismissed silver as manipulated suddenly realize that manipulation only works when supply exists. Once supply is gone, manipulation becomes irrelevant. This is why banks are panicking. They are not panicking because price is rising. They are panicking because inventory is leaving. Banks can manage volatility, they can manage margin, they can manage sentiment. What they cannot manage is absence. You cannot hedge what does not exist. The exposure is not linear, it is exponential. Every ounce withdrawn increases the stress on every remaining ounce. Every delivery request increases the risk that the next one cannot be met. And once even a single failure becomes visible, behavior across the entire system changes. This is how confidence dies. Not with a crash, but with a realization. The realization is this: if everyone cannot be paid in metal, then no one wants to be last. This is why withdrawals spike. This is why behavior changes suddenly. This is why the system always looks stable until the moment it isn't. History does not repeat exactly, but it always follows the same structure. Fractional systems survive on belief. When belief breaks, assets reprice to their physical reality. Silver's physical reality is brutally simple. There is less available than the world requires at current prices. That gap has been masked by paper. Paper can stretch, metal cannot. Once enough people choose metal over paper, the stretch snaps. This is not a forecast. It is already in motion. And here's the part most people still do not understand. The danger is not missing upside. The danger is being trapped in claims when conversion is no longer possible. The danger is discovering too late that liquidity was an illusion. A bank run does not announce itself with sirens. It begins with quiet withdrawals. It begins with informed exits. It begins with inventory shrinking faster than it can be replaced. Only later does it become obvious. Only later does it become visible. By then, the outcome is already locked in. $100 silver is not bullish speculation. It is the mathematical resolution of a system that promised more than it could deliver. And once that level is breached, the next question will not be how high price can go, but how much metal remains accessible. Because price does not matter when availability disappears. This is the phase where preparation matters more than prediction. This is the phase where positioning matters more than timing. This is the phase where holding claims becomes a liability instead of an asset. The silver market is sending a signal that cannot be misinterpreted. Withdrawals are accelerating, trust is declining, competition for physical supply is intensifying, and the system's margin for error is gone. This is what a confirmed bank run looks like in its early stages. It does not look dramatic yet. It looks quiet. It looks technical. It looks manageable. That is always how it looks right before it isn't. And the people who understand this do not wait for confirmation from headlines. They watch behavior, they watch inventory, they watch withdrawal rates, and they act before the crowd realizes the rules have changed. Because once the crowd moves, there is nothing left to move into. Once a bank run enters its second phase, the mechanics change. In the first phase, withdrawals are driven by awareness. In the second phase, withdrawals are driven by fear of exclusion. This is the most violent transition a market can experience because logic no longer governs behavior. Survival does. We are now crossing that threshold. In the early stage, participants ask a simple question: should I convert? In the next stage, the question becomes, will I still be able to convert if I wait? That is the moment when systems fail, not because they are attacked, but because they are overwhelmed by rational self-interest acting simultaneously. This is what is unfolding in silver right now. The vault withdrawals you are seeing are not random. They are not speculative. They are strategic. They represent entities that understand something critical. The moment physical silver becomes visibly scarce, access shuts down faster than price can adjust. By the time price reflects reality, the metal is already spoken for. This is why price lags behavior, always. Markets do not move because of news. They move because of positioning. News only explains the move after the inventory is already gone. That is why those who wait for confirmation always arrive too late. The reason $100 silver is inevitable from this point forward has nothing to do with hype and everything to do with clearing mechanisms. At current withdrawal rates, the available pool of deliverable metal is shrinking faster than new supply can replace it. Mining cannot respond. Refining cannot accelerate. Recycling is price sensitive and slow. There is no elastic response available. When supply is inelastic and demand becomes urgent, price does not rise gradually. It resets. But here is the detail that most people still fail to grasp. The reset does not happen evenly across the market. It happens first in the physical layer, then violently in the paper layer. By the time futures and ETFs adjust, premiums have already exploded and access has already narrowed. This is why the idea of waiting for a pullback no longer applies. Pullbacks exist in liquid markets with surplus inventory. They do not exist in rationed markets. In rationed markets, availability disappears first and price follows later. The banks understand this. That is why their behavior has changed. They are no longer attempting to suppress price aggressively. They are no longer flooding the market with confidence. They are shifting into containment mode. Containment is what happens when control is lost, but collapse must be delayed. It involves slowing withdrawals, discouraging delivery, widening spreads, raising friction, and managing optics. None of these actions fix the underlying problem. They only buy time. and time is exactly what is running out. The structural flaw is simple. The paper-silver market was built on the assumption that delivery demand would always remain marginal. That assumption is no longer valid. Industrial demand is increasing. Strategic demand is increasing. Investment demand is shifting from paper to physical. All three pressures are converging simultaneously. This convergence is what turns stress into failure. When a single participant asks for delivery, it is manageable. When many do, it is dangerous. When most do, it is terminal. The system cannot honor universal claims. It never could. It only worked because it was never tested. That test is now underway. The reason banks are panicking is not because they fear losing money on price movement. They fear losing credibility. Once credibility is gone, the paper market ceases to function. Liquidity evaporates. Spreads widen uncontrollably. Volatility explodes. And risk becomes unquantifiable. Unquantifiable risk is fatal to financial institutions. This is why the behavior is shifting behind the scenes. This is why access is becoming more difficult. This is why premiums are rising faster than spot. This is why delivery timelines are extending. These are not isolated events. They are symptoms of the same disease. A system that promised convertibility without maintaining sufficient reserves is now being asked to prove its promises, and it cannot. At $100, the psychological barrier breaks. That is when broader awareness kicks in. That is when participants who dismissed silver as irrelevant suddenly recognize it as essential. That is when capital that ignored the metal begins to chase it. That is when demand accelerates not linearly, but exponentially. But here's the cruel irony. By the time silver reaches $100, the opportunity will already be gone for most participants. The price will exist, but the metal will not. Access will be restricted, allocation will be rationed, premiums will detach entirely from spot. This is how markets signal scarcity, not through price alone, but through friction. The more difficult something becomes to obtain, the more valuable it becomes, regardless of its quoted price. This is the difference between theoretical value and real value. Paper trades in theory, physical trades in reality. Reality always wins. What comes after $100 is not a smooth continuation. It is a regime change. It is the moment when silver stops behaving like a traded commodity and starts behaving like a strategic asset. Strategic assets are not priced by markets. They are allocated by necessity. This is why comparisons to past cycles are misleading. This is not a replay. This is a transition from abundance illusion to scarcity enforcement. Once that transition is complete, the rules are rewritten. In that environment, price targets become meaningless. There is no equilibrium, there is only competition. And competition does not respect charts. Those who hold physical metal are no longer speculating. They are insulated. Those who hold claims are exposed to policy, counterparty risk, settlement risk, and political intervention. Because once a resource is deemed critical, it stops being governed by free markets. It becomes governed by power. This is the stage we are entering. When withdrawals spike, authorities take notice. When authorities take notice, controls follow. They may be subtle at first. Reporting requirements, allocation limits, settlement delays, eventually explicit restrictions. These measures are not designed to protect investors. They are designed to preserve system stability and ensure strategic access. Retail access is always the first to be sacrificed. This is why waiting is dangerous. Every historical example of a resource transition follows the same arc. First denial, then quiet accumulation, then visible stress, then panic, then control, then repricing. The people who benefit are those who act during the quiet phase. The people who lose are those who wait for clarity. Clarity always arrives too late. We are now past the quiet phase. The bank run is confirmed not because of headlines, but because of behavior. Behavior never lies. Behavior reflects incentives. And the incentive right now is to secure what cannot be printed, duplicated, or promised. Silver meets all three criteria. The $100 level will not stop this process. It will accelerate it. Because once that threshold is crossed, the narrative changes. It stops being about upside, it becomes about preservation. And preservation demand is far stronger than speculative demand. Speculators sell into strength. Preservers buy regardless of price. This is why the move will not end at $100. That number simply marks the end of denial. After that, the system must confront reality, and reality is unforgiving. There is not enough physical silver to satisfy global demand at current structures. There never was. The only reason this imbalance persisted was because paper filled the gap. Now paper is being rejected. Once paper is rejected, price must rise until demand is destroyed or supply appears. Supply cannot appear. That leaves demand destruction. Demand destruction only happens at much higher prices. This is the uncomfortable truth no one wants to say out loud. The silver market is not heading toward equilibrium. It is heading toward resolution. And resolution is not gentle. By the time this process finishes, the world will look back and wonder why the signals were ignored, why the withdrawals were dismissed, why the warnings were downplayed, why people trusted promises over possession. The answer will be simple: because it was uncomfortable, because it challenged assumptions, because it required acting before certainty. That is always how it happens. This is not about predicting the future. It is about recognizing the present. A confirmed bank run is not something you trade. It is something you respond to, and the response window is closing. Once access closes, no amount of conviction will reopen it. The choice is not between buying now or buying later. The choice is between participating in the resolution or being trapped by it. That choice still exists today. It will not exist for long. And the people who understand this do not wait for confirmation from headlines. They watch behavior. They watch inventory. They watch withdrawal rates. And they act before the crowd realizes the rules have changed. Because once the crowd moves, there is nothing left to move into.